Today, we will conduct a full financial statement analysis of Microsoft, mainly based on its 10K filing and decades of financial data. As always, we will start by looking at ROE in order to get a quick sense of the company's business quality. As we can see here, Microsoft's ROE in the past 30 years was well above 20% hurdle that we use to screen for great businesses. Its average ROE in the past 10 years and 20 years are both 32%. However, these ROE numbers are a bit misleading, because as we can see here, Microsoft has been sitting on a huge amount of cash pile during that time. This cash is not being put to use for operations, so it lowers the ROE numbers we calculate. In order to account for that, I adjusted this original ROE equation by subtracting net cash at the bottom and also subtracting after-tax interest income in the top. So this adjusted ROE shows how much return Microsoft generates ignoring the impact from the cash balance. And I added this adjusted ROE on top of the original line as a new blue line here. The result is much higher return for shareholders than before, and the 20-year average for this new adjusted ROE is 65%. So all in all, there is no doubt that the business quality of Microsoft is top of the class. Over the past 30 years, Microsoft's revenue decreased only twice, in 2009 and 2016, and in both cases, it fell for less than 5%. And for the past 20 years, its revenue CAGR was 10.2%, and operating income grew by 11.7% per year. This is already pretty good, but its growth is accelerating recently. And in the past 5 years, revenue grew by about 16% per year, and operating income by more than 23% per year. At this new pace, Microsoft's profit will double in every 3.5 years, so it'll be quite amazing to see such a large company growing at such a fast pace. In terms of the operating margin shown in the dotted line here, such high number near 40% makes sense, because Microsoft is mostly a software company. And if you look at the yellow operating income number in more detail, from 1993, the success of Windows for PC and other business softwares carried decent growth for the first 15 years up to 2008. However, Microsoft struggled for some time in the middle because it missed the transition of computing to the internet and mobile. But luckily, Microsoft successfully grabbed onto the next wave of computing, which is the cloud computing through mega data centers. And since the mid-2010s, the company's profit is exploding again. Another income statement item that caught my eye is the R&D expense, which is increasing to more than $26 billion in 2022. The sheer size itself is interesting, but Microsoft spends more money on R&D than it does on CapEx. And as percentage of revenue, R&D is consistently above 13%. So this means if Microsoft lowered the R&D expense just a little bit, its operating margin can even go above 50%. The largest asset that Microsoft holds is cash, which is shown in the green here. As we saw before, the cash balance is very large at almost $100 billion. And since this cash is not deployed into operations, having so much is not necessarily good for shareholders. But out of this $100 billion, $68.7 billion will be used for Activision Blizzard acquisition if the deal receives regulatory approval in 2023. The purple part here, which is the third largest item on the asset side, is also related to the M&A activity, because it's mostly goodwill, which is generated as a result of M&A deals. For example, Microsoft paid $18.7 billion to acquire a healthcare AI company called Nuance Communications in 2022. And to account for this acquisition on its book, Microsoft assigned $4.3 billion to intangible assets and $1.9 billion to liabilities. But for the rest of the money that Microsoft couldn't assign to specific assets, it recognized $16 billion of goodwill on its asset side. Because Microsoft mostly buys companies with valuable intellectual properties rather than many hard assets, and also because Microsoft pays high premium to buy the most advanced technology, goodwill generation is quite consistent. For instance, the ZeniMax Media gaming company acquisition in 2021 also created $5.5 billion of goodwill out of the $8.1 billion that it spent for the whole M&A. As a result, Microsoft was sitting on $67 billion of goodwill in 2022, and this is quite large even for Microsoft. The company spent total of about $100 billion to acquire companies, and so far it recognized $11 billion of goodwill impairment, which is basically admitting that they overpaid for a company. About half of that $11 billion of loss was for an online ad sales company called Quantive in 2012, and the other half was for the well-publicized failure related to the Nokia's cell phone business in 2015. And if you're interested, you should check out those M&A stories to see how Microsoft's large bets don't always pay off. The second largest asset item is PP&E, shown in the blue line. This might be surprising to some, because Microsoft is a software company and doesn't really produce any physical products by itself. So what is this $100 worth of hard assets? As we can see in the footnote, most of the PP&E is for buildings and computer equipment that are used in data centers. Cloud computing, led by Azure, is the fastest growing business for Microsoft. And this business is not asset-light like software or internet services, so investors should pay attention to how this is impacting Microsoft's cash flow going forward. Then let's check out the CapEx that's being poured into the cloud computing. For the first 20 years since 1993, Microsoft invested about $1 to $2 billion into CapEx each year. But as cloud computing business picked up in mid-2010s, CapEx went well above $5 billion per year. And the company spent almost $25 billion alone in 2022. But even this is not the peak investment for sure. And Microsoft CapEx is expected to increase further as it builds larger and larger data centers, some even underwater, with higher computing capacity to now run even artificial intelligence. So investors need to check out how much actual cash return that they're generating for each dollar invested in CapEx. In order to calculate this, I conservatively assumed that all the buildings and computer equipment that Microsoft has are used for the cloud business. And after deducting the proportional accumulated depreciation, Microsoft has about $63.5 billion of hard assets supporting its cloud business. And in fiscal 2022, Microsoft earned $32.7 billion of cloud operating income. So the pre-tax return on investment is 52%. Needless to say, this is very high return. So instead of worrying about CapEx increasing too much, we should probably hope for that Microsoft can continue to invest more and more money into the cloud computing as long as it can maintain its over 50% ROIC. Now, let's look at the three main components of cash flow. First, operating cash flow, shown as the blue bar, increased more than sixfold from $13 billion 20 years ago to nearly $85 billion in 2022. And surprisingly, the conversion rate from operating income to operating cash flow was 99.6%, which is as good as it gets for shareholders. The orange bar represents investments that Microsoft made, and the significant increase in 2017 stood out, so I looked up, and that number includes $26 billion that Microsoft spent to acquire 100% of LinkedIn. Lastly, the yellow bars are cash flows from financing, and it's definitely not so small in size. This stands out because usually, fast-growing tech companies don't return capital to investors because they are very focused on the growth itself, which eats up a lot of cash. So now, let's analyze how Microsoft generated and deployed cash flows over the past 10 years. In 2012, the company had $62 billion of cash on its book, and over the 10 years, it generated about $480 billion from operations, very cash generative as we expected. And then it spent about $120 billion in CapEx, and also insignificant $110 billion in M&As and other investment activities. Next, Microsoft borrowed more than $100 billion. This is a bit surprising, because as you can see, Microsoft generated so much operating cash that even after spending several $100 billion for R&D, CapEx, and M&A, it still was sitting on more than $300 billion of cash. So, why borrow more money and pay interest expense on those borrowings? To answer this mystery, let's see the debt that Microsoft raised since 2009. This can be found on the footnote 11 of 10K filing. Since the 2008 financial crisis, the interest rate was ultra low near zero for about a decade. So Microsoft was able to borrow billions of dollars for only about 2 to 5% range. But when Federal Reserve began to raise rates in 2018, Microsoft stopped borrowing because in the end, it doesn't really need the cash if the cost of borrowing is not low enough. But as Fed lowered the interest rate again due to COVID crisis in 2020, Microsoft borrowed another $18 billion at a very low rate of 2.5 to 3%. And again, Fed began to raise rates in 2022, so Microsoft stopped borrowing now. Another noticeable fact regarding the debt is very long maturity. For example, in 2020, Microsoft borrowed $10 billion at about 2.5%, and it doesn't have to pay back that $10 billion of principal for 30 to 40 years until 2050 to 2060. This is quite advantageous deal for shareholders because this 2.5% is now much lower than the current inflation rate. And if the company just banks the money that's borrowed in short-term treasuries, it can receive more than 4.5% interest income while paying just 2.5% for the interest expense. But of course, we know that the company is investing in cloud computing that's generating near 50% return on capital. And the company's overall ROE is more than 30%, even if we include the idle cash. Even after finding out that Microsoft was taking advantage of ridiculously good rates and maturities that the credit market was providing, the question still remains, what does it do with all that ample cash? And the answer is stock repurchase and dividend, which were $160 billion and $130 billion each for the past 10 years. And with the near $100 billion of cash remaining, it will spend about 70% in order to buy Activision Blizzard in 2023. So basically, looking at this chart, we can realize that Microsoft is very opportunistic in taking advantage of the free money that the credit market throws out, and also returns a lot of capital to shareholders, even as it's growing its operations very quickly. However, regarding the stock repurchase, we need to note two things. First, the share count is not decreasing as much as one would expect by just looking at these billions dollars of spending for share buybacks. And that's because, as we can see on the table, the company is issuing so many shares to compensate employees as a form of SBC. Second, share buybacks are only beneficial to shareholders if stocks are bought back at prices lower than the intrinsic value per share. But if we look at the valuation multiples for the past 30 years, it's not so clear if the current Microsoft stock price is cheap enough or not. So we need to get better grasp of Microsoft's intrinsic value before cheering for the tremendous amount of cash spent on buybacks. Okay, that's it for today's video, and here is the summary of what we learned about Microsoft. And in the next video, we will dive deep to calculate Microsoft's intrinsic value through a detailed financial model. So please subscribe to the channel and click the like button below if you found the content useful. Thanks guys.